Today, every day, small cap investors visit Agoracom knowing this is the day to discover the world's next great company, to have their dreams come true. That's why I take to the open road, to find them, to tell their stories, to engage them, to bring them to life, because they want to connect with you from your office, your phone, your home, anywhere. Agoracom, find your dream.
Welcome to Beyond the Press Release, a production of Agoracom in which we take the time to speak with small cap executives right after recent important news. With us again, I'm happy to have Jesse Dillon, his CEO at Good Life Networks. The company trades on the TSX Venture Exchange under the stock symbol GOOD. That's good, and we're talking about good to great. Also, recently listed for our friends in Germany and Frankfurt under the stock symbol 4G5. Now, for those of you who are new to the story, and that's still going to be a lot of you because the company didn't go public until early this year, GLN is a programmatic advertising company. And in layman's term, what that means is they automate the buying and selling of advertising, and specifically video advertising. And maybe you've probably heard that before, that kind of story, but the similarities end there because their artificial intelligence makes 100,000 calculations per second to bring the best matches between advertisers and publishers. Their network reaches more than 750 million users, which helps them get higher volumes and leads to better prices. Last year, they had record revenues for the full year of 2017, in fiscal 2017, with revenues of $9.7 million, up 278%. Here, what we're talking about today, they just put the Q2 numbers, record revenues, record income, record gross profits, all of it. Here to talk about is Jesse. Welcome to the show.
My favorite Greek, George. My favorite mad Greek. Good to be back.
Glad to have you. And look, you're on vacation. You know, you're in the parts unknown, but it looks like you're, having some recreational time with yourself and your family. But you're breaking the internet with the numbers you're putting out. I'm going to give a couple of specifics here. Q2 revenues, $3.4 million and change, up 123%. Gross profit, almost $1.6 million. That's up more than 280% from 600,000. And a lot of people don't know about the first half numbers. $4.7 million, up 197%. Gross profit, $2 million versus 614,000. How do you attribute this kind of growth? Where is it coming from? All organic acquisitions? Where's it coming from?
Well, we built a machine, a few years ago. We launched our beta test, in April 2016 with a very high-speed video exchange advertising platform. They're very difficult to build. Luckily for us, we had an incredible team. In fact, in your opening remarks today, you were talking about a great book, a gentleman that I've interviewed many times in the past. James wrote that book, Good to Great, and they studied 14,000 companies, and 11 had the propensity to be able to make it from good to a great company. Interestingly enough, one of the things that they had in common, or one of the commonalities for a few companies that made the jump from good to great, they had the right team. It almost didn't matter what the product was, so much as the team. And James in the book used the analogy of a bus. Make sure all the right people are on the bus and the wrong people are off the bus. So we made sure from the get-go that we had the right team. If we were going to be big in advertising technology, we had to build a tech stack from the ground up and go to market with a very solid technology team. So, first company that I bought in this space was, in my opinion, the top tech stack and the top tech team in the marketplace. They were the top consultants for the biggest players in the place and had built an incredible technology stack. So, George, that's our foundational piece, and that's why we're growing so fast. Our algorithms, our machine learning, our system is now making 110,000 decisions per second. A year ago at this time, it was making 50,000 decisions per second. So we're very fast. Again, brand safety is another reason. Big brands like the US telco we just did a deal with, and we're operational, making money with them now. We're under NDA. We can't mention their name. Hopefully we'll be able to do that sometime this year. But they came to us not so much just because of the speed, but also because of the brand safety. And with things like PII, personally identifiable information, and companies like Facebook breaching, I don't want to say their fiduciary responsibility, but
Big problem.
This hasn't been a very popular thing to do with users taking their personal information, using it against them to sell ads. We built a machine that's as effective as that, but doesn't use personal information. It's a lot like the Matrix. It's making 110,000 decisions a second to find the right user for the right consumer, marrying the advertiser and the consumer. So those are reasons we're growing so quickly. And I'll be frank with you, going public, not a lot of companies in the advertising technology space have gone public. Really, only a handful.
Yeah,
and
probably because they're terrified of the competition. You've got Google up there. You've got Facebook, who's still a powerhouse. You've got some other social media platforms, even Twitter. So it's a pretty daunting task. And yet it doesn't seem as if you guys are afraid of the competition because you've got NDAs with Fortune 500, US-based telcos. I want to drill down a little more into that. What I want to go to is your gross margins in that same light. You've grown your margins from 38% to 46%. That's
right.
A pretty significant jump. So you're not only growing your top line, but you're growing your margin. So is that also a tribute to your technology? Is it just making things more efficient, or are you guys just getting a better and better reputation out there and able to land better and better customers?
It's a great question, George. Let me just finish one quick point. tsx-v going public has given us great visibility in the marketplace and open transactions, open book. Everything's published in CDAR. So we're finding a really good queue of acquisitions at really attractive prices because of our public market visibility. To your question regarding margins, we had set our margins at 25 to 30%. We'd be happy at margins of 25 to 30%. We're growing quicker than we thought. Our efficiency is greater than we thought. Since 2017, we published our financials for 2017, Q1, Q2. We're running ahead of schedule with margins. We're going to go through another quarter. We set them at 25 to 30. We're hitting 40 to 46% margins, George. Let's go through another quarter. We'll be conservative. If we're still at 40 to 46% margins, we'll escalate our margin targets higher, which can only be good news.
You've also got the benefit of, and I don't want to say it's luck because obviously you identify it, but this video advertising is the future. And a lot of people watching are probably making the assumption, which most of us, even I did, that you're talking about YouTube videos and general online advertising and videos. But you're also hitting the CTV market, which all these streaming companies like Roku who are growing out of control, and they need those kind of services need advertising within their video services. So how big of a wave are you riding on the back of right now? And is that just good fortune, or you guys saw this coming?
Well, listen, if you're going to lay it out there for me to pick from the sky like a ripe apple, of course we saw it coming, George.
Some of it at least, right?
It's also good fortune. I mean, really, it's right place, right time. We did see connected television coming. It's growing incredibly quickly. Trade Desk, which is a great $4 billion plus advertising technology company, in their last couple of quarters, they reported a huge margin of growth, 20% or higher, related to connected television. So what's the trend? People are unplugging from cable. They're going directly online. Millennials and Generation Zs never went to cable. They only got a smart television or a device and go directly online. As soon as you're off cable or don't go to cable, you're ours. We can serve you a video ad. Because we have such an uber successful, high efficiency trading platform that makes 110,000 decisions a second, it's a perfect fit for connected television. So we're very close to a definitive agreement with Impression X. Who knows, by the time somebody's watching this, it may have been signed. We've had to do a lot of due diligence. Companies that have gone public have bought the wrong companies. They haven't worked. That's not us. We're a tech company from the get-go, and we have to make sure that everything that they have is legit, correct, and fits beautifully, strategically, and is also accretive to earnings immediately with our platform. So our first acquisition this year fits those criteria. We finished our due diligence. The definitive agreements are drafted. We're pretty close to signing them, and that'll happen imminently. When we get into connected television, that's an interesting space to be in. And in advertising technology, it's growing very, very quickly. Yeah. It's new. It's rapid growth. We think that'll be an X factor to our growth and a lot of blue sky. We think that the attractor factor here is the purchase price. We've been doing business with these guys in other areas before CTV. We've been successful. We have a 1.5-year track record with them. It's been good for both brands. They love the fact that we're visible now in public, and they want to tie in with us. So it's a great opportunity to snag something at a low cost. Our total expenditure for that, George, is $500,000 US. They earn the rest over time. We're happy for them to earn more money. We're happy for them to earn some warrants. They're going to have to work for it. And in essence, don't tell them, but we're really paying them with their own money. But bottom line is they get a chance to be part of a rapid growth company that's going to be a big deal. They see that and they're in. Quickly on the telcos. Telcos are now moving into advertising technology, and so are media companies. Pandora bought an ad tech engine. AT&T bought one of our competitors, AppNexus, a couple of weeks ago, 3 weeks ago, for $1.6 billion US. There are not a lot of exchanges out there. There's all kinds of SSPs and DSPs, demand-side platforms, supply-side platform companies. There's very few exchanges. So we are one of the best exchanges in the free world that hasn't been bought by a major telco or Google or Facebook or reasonable facsimile. Those are key intersectional themes coming up, intersectional ideas, George, and we're kind of in the right place at the right time. It's good timing for us.
And in fact, Jesse, we had our own anecdotal kind of situation here supporting what you're saying. My kids are fans of Better Call Saul, the TV show, and up until now they've been watching Netflix and able to binge watch their shows, watch them when they want. Better Call Saul's on regular cable, and they got to watch it once a week. And just the other day we watched it, we PVR'd it, and they said we can't do this. We'd rather wait till it's on streaming rather than have to sit here and wait a week at a time to watch a show. So clearly, we haven't seen the beginning of cutting the cable and how big of an industry you guys are about to go right into here.
Well, there's close to a billion screens already. The U.S. telco that we did deal with, we're talking about media unplugging from cable, emerging large digital companies getting in, buying ad tech engines. The point that I wanted to make, and the point that I think you're making, George, is if you are a high-speed, efficient video exchange built on brand safety and you're growing quickly, and you can help companies like AT&T and others understand the game because they want to be in it, they don't want to build it, they want to buy it. Very good timing for us. And if we get as large as I think we can next year, we're having interesting discussions with large media consortiums about adding horsepower and new revenue streams where they currently don't exist in the new emerging world of advertising technology.
And normally, you'd have to take that with a grain of salt, but your quarterly numbers, your full year numbers are proving that out. You're growing at exponential rates, and you'd expect, that you guys be running into ferocious competition out there, and either remaining stagnant or dropping. And in fact, you're growing pretty quickly. Last thing, what I love about your company is you're hitting on all cylinders. So we talk about the financial side and how the company's growing organically. You're growing margins. Acquisitions are coming in. Commercial partnerships with Fortune 500 telcos, but you're also going another level deeper and kind of building on top of your business, which is this accounts receivable blockchain application. So you're going even deeper into the relationships with the publishers and sellers of advertising and sellers of advertising, because you've got this problem out there where the accounts receivable cycle can be 180 days long, and you think you're going to solve this. How much closer are you guys to that solution? And tell us a little bit about what you're trying to accomplish there.
Somewhere in the neighborhood of 700 to 750 billion a year. And the last time we talked, it was 650 billion. It's now 750. 748 billion a year floats around the planet in advertising. The biggest pain for all of us in the advertising business, particularly advertising technology, is getting paid. Google, Procter & Gamble, or Ford come in at this end and spend money with us, and we blow it out the other end to publishing sites like CNN, Wall Street Journal, Toronto newspaper, digital online consortium, or New York Times, whatever. We don't get paid by those big blue chip establishments and international advertising agencies until 90 days on the nose, and then we get paid. When we get paid, we pay the publishers. That's how it works. The problem is there's a lot of middlemen, and sometimes the middlemen aren't paying other publishers for 180 days, 8 months, sometimes never. So in the emerging world of advertising technology, approximately 5 billion US a year, North America alone, gets factored at 27% per annum. Companies like Silicon Valley Bank, FastPay in Los Angeles, great companies, and they're factoring people's receivables. Because of compression in margins, we're able to fortuitously see an increase in our margins because of our efficiency. We have 10 employees, George, including me. We make $10 million last year. That's $1 million ahead. We're doing, if we do 2 acquisitions this year, we'll do 2 acqui-hires for each company, maybe add a 5th. You know, I mean, you do the math. We're small. We're very efficient. We're a machine-driven company. Sales companies that are out there in the same business that we're in, I mentioned them, DSPs and SSPs, they've got teams of 40 out there buying steaks and red wine, trying to win Corona or BMW or Harley-Davidson business. We don't do that. You know, we deal with the big companies, blue chip. It's still a problem, though, for most people out there collecting. It's a pain in the you-know-what. So we've been working with some very large entities and some very large liquid international exchanges to develop a currency to be able to clean up accounts receivable. We have a provisional patent on that, so that's the first. We're very refined in the approach. We're very ready to start testing. I say very ready to start testing soon. I don't see this in the market until 2019, but I do see it in the market in 2019. And I see us being able to pay publishers next day. We call that T+1. I see us paying publishers next day, not 90, not 120, not 180. We already have the relationships with the inflow and the outflow. Why not pay everybody next day? We've made a few phone calls, talked to a few significant people, and there's kind of a lineup for that kind of activity, so they don't have to factor 27% per year. They factor because they go out of business with 40 to 50% of their working cap tied up in receivables. We can clean that up. Blockchain was made for that. It's a good fit.
Safe to assume that not only speeding up payments and using blockchain, but that'll also bring you more customers at the end of the day, because a publisher like me is going to say, hey, I might as well get onto Good Life Networks because I'm going to get paid a lot faster. So you may not have, you know, a Agoracom. Let's assume it's a big conglomerate that can be a customer of yours. You may not have me today, but I'm out there factoring my receivables at 27%. How is it safe to assume that's a fantastic business development tool? Because now you just call George and say, hey, George, I know you deal with that guy, but I can get you paid the next day, and you don't have to lose 27% of your profit to factoring.
No, that's correct. The ad tech industry, like, you know, other industries, broadcasting, tech, automotive, it's a small world. We all know who the significant players are, and we all know who the insignificant players are. If you have a significant player paying people next day, you know, John picks up the phone and calls Nancy and said, you know, are you still factoring? Look, I know you were having some issues. I'm getting paid next day. It'll spread very quickly. Wildfire.
It's a no-brainer. So that's what I want to point out to everybody. And I know you're on, you know, a little bit of retreat, a little bit of vacation, but you put these numbers out yesterday, and we gotta, you know, I'm glad that you're able to join us today just to put a little more color on them. That means a lot to us. But I think the takeaway for everyone is you're hitting on organic, you're hitting on acquisition, high-level commercial partnerships, Fortune 500, and you're looking to expand your technology offering that's going to make things better for the industry, which is only going to bring you more customers. So last word to you, how happy are you with this result, and how do the next 12 months look in your eyes in terms of your optimism of what's happening?
I'm thrilled with the result. I'm thrilled for the team that has created this result. You know, I have an incredible group of people, much smarter than me, that I've been able to surround myself with, from our market makers to our investment banks to, of course, the staff and the people that are shareholders of the company. We are, and this is kind of with a mixed blessing, I say this, Canada's, greatest young tech company that most people have not heard of. So my mission now is to make sure that most people have heard of this company and are going to hear of this company. I come from an award-winning broadcast career. I hope I'm not self-aggrandizing, but I spent 35 years behind television and microphones. And if I don't know how to market and toot our own horns, I've learned nothing. I do know how to do that. I wanted to go through a few quarters of success, including 2017, Q1, Q2, last year. We're tracking. There's a pattern. It's now time for us to step out, put some light on this company for the benefit and respect of my shareholders, my stakeholders, my staff, and people like you who've given us your time. We need to become one of the better known companies in this country and elsewhere in the world. We're ready to take center stage. We're ready to step up, and that's where we'll be moving from here.
Well, we agree, Jesse. That's why we've got you on the Agoracom. That's why we've got you on the shows. You are Canada's one of the top 5 best undiscovered companies yet. Congratulations on your achievement for this quarter and for the first half of the year, and can't wait to see what you're going to be bringing to us in the latter half of the year. Enjoy your vacation. Thanks so much for taking the time to get on with us here to talk to everybody.
Thank you, George.
You've been watching Jesse Dillon. He's Chief Executive Officer at Good Life Networks. The company trades on the TSX Venture Exchange under stock symbol GOOD. That's good. And for our friends in Germany on Frankfurt under 4G5. To get more information about the company, get to Agoracom, punch in the company's name or stock symbol, take a look at the profile, all the information we have, and make sure you watch the previous interviews we already had with Jesse. Everything he said has actually transpired. His revenues, his income, everything is growing. That's the kind of success we like to see, consistent success that's going to have great success for all small cap investors at home. Thanks for joining us, everyone. Have a great day. Have a great weekend. We'll see you next time.